All right, let's get into a really interesting economic puzzle that's unfolding right now. On the surface, we're seeing some fantastic news about the U.S. economy. But if you scratch just a little bit beneath that surface, there's a story that has some of the world's sharpest economists pretty worried. So here's the big question, right? How can both of these things be true at the same time? We've got data showing that inflation is finally cooling off. But then you have these serious warnings about a repeat of one of the worst economic periods in modern American history. It sounds like a total contradiction. So let's break it down. First up, let's look at the good news. This whole conversation really kicked off with one single number. A number that, honestly, it was a big and very welcome surprise to just about everyone. And there it is. 2.7%. That was the inflation number for November, and it came in way lower than the 3.2% that everybody was bracing for. Now, on paper, this is amazing news. It's exactly what you want to see. It's a clear signal that maybe, just maybe, the fight against rising prices is finally being won. But, this is where the plot thickens. Almost immediately, people started getting skeptical. See, October's data was actually skipped because of a government shutdown, which led some analysts to worry that the starting point for this new number was, well, kind of distorted. And that little bit of uncertainty, it completely opened the door for a very different, much more pessimistic view of what's really going on. And this right here really shows you the giant gap between the official data and what people are actually feeling in their day-to-day lives. The government is saying inflation is down at 2.7%, but the public, they expect it to be almost double that, 4.8% in the next year. And that is a massive disconnect. It's also pretty dangerous because when people expect prices to go up, they start acting differently. And that behavior can actually help make the inflation they're worried about become a reality. So as you can probably guess, that surprisingly good 2.7% number was immediately grabbed and framed as a huge political victory. Yep, the White House jumped on that number as absolute proof of a historic boom. But look, it's not really the celebration that has economists on edge. It's what the president said he wants to do next. And here we get to the heart of the matter. The president has been very publicly pushing for the Federal Reserve, that's the nation's central bank, to slash its main interest rate all the way down to zero. You can think of that rate as basically the master dial for the cost of borrowing money across the whole economy. Bringing it to zero would make money super cheap, sure, but it also runs the massive risk of overheating the economy. And this demand is coming at the same time he's looking for a new Fed chair who's willing to play ball. Now, this kind of political pressure on a central bank, it is not new. In fact, for anyone who studies economics, it brings up this really painful and very specific ghost from America's past. Okay, to really get why people are so nervous right now, you have to know about this guy, Arthur Burns. He's kind of infamous in Federal Reserve history. In fact, he's sometimes known by the not-so-flattering nickname, the Fed villain. And the story of how he got that name is a huge cautionary tale. This timeline basically shows a complete disaster in slow motion. You've got President Nixon, who's heading into a re-election campaign, pressuring his Fed chair, Burns, to keep the economy juiced up by keeping interest rates low. And Burns did it. But then, bam, the oil shock hits, prices go through the roof, and the Fed is completely caught flat-footed. The result was nearly a decade of out-of-control inflation, a period we now call the Great Inflation. Which, of course, brings us right back to today. Why are so many economists drawing a straight line from the ghost of Arthur Burns to what's happening right now? Well, here's the big concern. While the administration is celebrating 1 month of low inflation, its own proposed policies are pretty much across the board fundamentally inflationary. You've got plans for massive government spending, which juices up demand. You've got trade tariffs, which directly make things we buy more expensive. And then you have that constant push for 0% interest rates, which just pumps more cheap money into the whole system. It's like a trio of policies designed to pour gasoline on a potential economic fire. So you might be asking, what would a sequel to the Great Inflation even look like? Well, a really respected think tank, the Peterson Institute, decided to actually run the numbers. They modeled what could happen if the Fed did cave to all this political pressure. And the results are, well, they're pretty stark. The model predicts a short-term boost to the economy, sure, but then it's followed by an absolutely massive crash. We're talking about a $3.6 trillion loss in the country's GDP by 2040. And inflation? It would spike by an incredible 41% above what it's currently projected to be. I mean, that is the literal recipe for a modern Great Inflation. Okay, so let's be clear. This isn't just some abstract debate for economists to argue about. This has very real, very direct consequences for your wallet,
for my wallet, for everyone's wallet.
The big lesson from the 1970s is that there's this really clear, damaging cycle. It all starts when politics get in the way of sound economic policy. Once that inflation genie is out of the bottle, it just eats away at the value of your savings. And trying to get it back in, that causes a whole lot of economic pain for everybody.
And that brings us to the most crucial point of all. The reason the central bank is independent isn't just some technicality. It was designed that way on purpose, to act as a firewall, to protect the long-term health of the entire economy from the short-term pressures of, say, an election cycle.
And really, that's the question we're left with as this whole thing plays out. Is the idea of an independent central bank just some stuffy old rule for economists to debate? Or is it the last real line of defense that we have protecting our entire economic future? It's definitely something to think about. Thanks for watching.